following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome to Volatility Views. My name is Don Schlesinger, and if it sounds a little strange, usually I'm introduced by our MC, Mark Longo, but Mark is not here today. He's on assignment in New Orleans, and he's covering the Options Industry Council. So I'm sure you'll be hearing some interesting interviews and shows that are being taped as we speak down there right now. So it's my pleasure to be joined today by our roving reporter from the Option Pit, Mark Sebastian. Mark, welcome again to the show.
Oh, always a pleasure. I am super excited for our guest today.
Yes, we have a very special guest later on in the program, Richard Sandor, and I'm sure we're going to have a fascinating interview with Richard. We're going to begin with our volatility review.
It's time for the Volatility Review.
And welcome to the Volatility Review. This is the portion of the program where Mark and I sort of take a look back over our shoulders at what has taken place in the past week in terms of volatility around the marketplaces. And I'm going to start off with a few comments regarding the volatility of NASDAQ, particularly that NASDAQ 100 product that we're going to be offering in the form of vol contract futures shortly. And listeners might remember last week I made a kind of a timid prediction that I thought we still could be going just a little bit higher. And as a matter of fact, all of the indices, 1 month, 3 month, 12 month, insofar as realized or actual market volatility in NASDAQ, did manage to inch up just a few basis points. I don't think I can take credit for any kind of a great prediction, but 21-day went from 770 to 1786, and 3 month from 1381 to 1394. So still a mild increase. If I would make one comment, it would be that we all know that this was a rather strong down week for equities, for S&P, for NASDAQ, for the Dow, for all the major indices. And it's something that we need to comment about when we talk about the potential differences between a realized volatility product and an implied volatility product such as the VIX. Ordinarily, when we have a market sell-off of the type that we had this past week, you'll see implied volatility with its negative correlation to price go higher, and that's exactly what we experienced in the NASDAQ VIX, in the S&P VIX, and there was a considerable increase in those indexes. Well, I just mentioned an increase in realized volatility, just defined by a couple of hundreds of points, a few basis points. And so the interesting thing here is, although we had a rather interesting decline in the past week, it wasn't a spike. It wasn't catastrophic. It wasn't a monumental sell-off on any one particular day. So what we really had was a kind of an orderly sell-off of the markets. They were down practically every day, but not dramatically so. And so what you can have in a case like that is implied volatility very dutifully goes higher because that's what implieds do. They go higher the vast majority of the time when the market is dropping. But by the same token, a realized volatility calculation, which is the actual movement of the market, in this particular case, wasn't very impressed, didn't go very much higher. I think that's simply because the sell-off was more gradual day after day, so that the actual market volatility itself was not particularly noteworthy. And yet, because the cumulative effect was a rather strong down week, you saw the VIX indices all going higher, which again is expected by that inverse correlation. Mark, did you see a similar type of thing over at VIX SPX?
Oh, absolutely. Yeah, we saw VIX and the SPX moving up with each other. Kind of something interesting that's going on now, Don. We've got a nice pop, a decent pop in the VIX, although if you look at it, right now as we're talking, the S&Ps are down about 20 handles. We just had a abysmal employment report, and there's some fear of French elections over the weekend as well. But we've only got the VIX up about 1.25. Well, once you adjust for kind of the weekend, I think you end up with the VIX up closer to 2 points, which is about right. One interesting thing that's happening, we've got on Monday, we're going to have the VIX cash trading around 19.5, maybe 1960, and we'll have the VIX future trading around 19.5, 1960. So we'll have seen that curve between cash and the May future completely flatten up. Well, if you've heard, we've seen a slow increase in realized volatility, and we're seeing the implied volatility futures start to flatten up relative to the cash. Now, you put that recipe together, Don, what do we think we end up with? Not a pretty picture in my opinion. I think that
Yep, that looks like it has all the ingredients for a continued sell-off, and maybe portending what we might talk about in the crystal ball in that last segment. And you did mention there are elections both in Greece and France over the weekend, and the strong potential, perhaps even the likelihood for new governments and new regimes there. And we've always talked about volatility, meaning instability, unpredictability, people getting nervous with the potential for new happenings and events, and these are the kinds of events that can fuel that even on a global basis.
Yep, and I always say that the bond market, in order of brains, it goes bond market, equity derivatives market, equity market, and 2 out of the 3, and the bond markets and the equity markets have been and the equity derivative markets, which is a Volex future is the NASDAQ future would be one of those, have been kind of pointing toward potentially a little slide here, and now we're seeing the equity markets follow suit. It's just we're just seeing the VIX. Although we're not getting to that kind of 20 level that everybody looks at that the market is actually, officially in a sell-off, it's still well below its long-term mean. Although I always like to point out that the number of occurrences of the VIX below 20, and this will be the same for the NASDAQ future when it starts trading, the number of occurrences below the mean will be much higher than the number of occurrences above the mean, but the magnitude of the occurrences above the mean will be much greater.
Right. Absolutely true.
So, a 19 VIX is actually elevated on a occurrence scale, maybe not on the long-term mean scale.
And of course, not so far away from that 20, because on a day like today, when S&P is down about 1.5%, we often see movement in VIX that is a considerable multiple of 1.5%. And so VIX up from the 17.5 handle into close to 19 right now is that increase of 1.5, but only on a 17 base, which is, like about 9% or so.
Right.
So surely almost like a 6-time multiple of the 1.5%. Won't take a heck of a lot more in terms of the index movement to get VIX to that 20 handle should we see further sell-off after the weekend events on Monday morning. So we'll take a closer look by the time our listeners are hearing this program on Monday afternoon. They'll already have seen how that plays out. Well, thanks very much for that, and that's going to do it for our volatility review. And now let's move on to our volatility viewpoint.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
And welcome to Volatility Viewpoint. This is the segment of the show where either we have a guest on and we are able to gain from the expertise of someone in the industry, or we just sit around and shoot the breeze among Mark Longo, Mark Sebastian, and myself. But that's not going to be the case today, because today we are honored to have not only a guest, but a very distinguished guest, Dr. Richard Sandor. Richard is the chairman and chief executive officer of Environmental Financial Products, and they specialize in inventing, designing, and developing new financial markets with a special emphasis on investment advisory services. And this was actually the predecessor company to the famous Chicago Climate Exchange, the European Climate Exchange, and the Chicago Climate Futures Exchange. Richard Sandor has been honored by the city of Chicago for his contribution to the creation of financial futures, and actually he has a nickname as the father of financial futures. He was honored by Time magazine as one of their heroes of the environment in late 2007 for his work on carbon trading, and he is a distinguished professor of environmental finance at the Wonghua School of Management in Peking University, as well as a lecturer in law at the University of Chicago Law School. And those are just some of the actual teaching experience of Richard, who has also been at the Kellogg Graduate School of Management in Northwestern, Columbia, Stanford, Berkeley. Richard, it's an honor to have you on the program. Welcome to Volatility Views.
Thank you so much, Don, and thank you for Mark for having me. It's a pleasure to be here today.
Yeah, I can't tell you how excited I am to be talking to you for this segment. I think that this is going to be a fascinating discussion, so I'm super excited.
And Richard, although you may in fact be a household word to many of our listeners, it's a tradition on Volatility Views that for a first-time guest, even for someone as well known as you, we like to give you an opportunity to simply introduce yourself, give us a short bio. In your case, it may be a little tougher to do than for the average person. You've been an industry icon for so many years, but take a few moments to tell us about your career in the financial industry and some of the high points.
Well, Don, I think you managed to cover a lot of it during your introduction. I started teaching at UC Berkeley in '66, took a sabbatical in '72 to become the chief economist of the Chicago Board of Trade, worked on writing the Ginnie Mae Treasury bond, Treasury note, and the first options on bond futures through the exchange, went on to the board of the CME, worked on the development of life in the early 80s, and in Matif as well, was on their International Advisory Council, and in 1990 worked on the acid rain program. The EFP, or its predecessor, did the first trade in rights to emit SO2, which was the beginning of cap and trade in America, and then founded the Chicago Climate Exchange. Ultimately, 18 months ago, selling it to the Intercontinental Exchange, where I had been on the board, and we licensed their technology and formed EFP a year and a half ago, and spent some time teaching at the University of Chicago and writing a book called Good Derivatives.
Other than that, Richard, nothing interesting that you've ever done?
No, I'm just a teacher at heart and a student at heart, Don. So I like to learn, and I like to teach others, and I'm challenged by problems and like to problem solve.
Well, we're excited to learn from you, and we'll talk about it a little bit later on. But as an independent member of our board of directors at the Volatility Exchange, it's been my pleasure to sit at many a meeting with Richard, and Richard is the kind of guy that when Richard talks, everybody listens. And so it's been a pleasure to learn from you over the last couple of years, as I'm sure our listeners will as well in the upcoming moments. Richard, you have now turned author, along with your many other achievements and your accomplishments, and I know you're anxious to tell us a little bit about this absolutely fabulous new book that's called Good Derivatives, a story of financial environmental innovation. It really looked fascinating to me. I started to look at the table of contents and tried to read some of the introductory chapters that you can look at Amazon. Why don't we start off with a simple question, Richard, but I think the answer is actually quite fascinating. Why the title Good Derivatives, and what is the implication there?
Well, ever since 2007 and 2008, Don, during the Great Recession, many people looked at derivatives as responsible. And it was a very broad sweep definition of a derivative, and often it was either sloppy or inaccurate. And I wanted to set the record straight. And in the United States, among the exchanges of cleared, regulated, and transparent markets, no TARP money was needed. There were no federal bailouts of any exchanges. Those derivatives worked very effectively. And the model that spread to 78 derivative exchanges worldwide in 36 countries, no exchange needed a bailout. The industry was castigated by many, and I thought the fact that the exchanges with the transparent, cleared model, regulated, had worked, and the story needed to be told. The other thing that motivated me was the man who wrote the foreword to the book, Ronald Coase, is a revered economist, a mentor of mine, a Nobel Prize winner, and he thought it was important to tell the story because most economists do what he calls blackboard economics, draw a supply curve, draw a demand curve, and assume that markets exist. And I've spent a lot of time trying to create markets, sometimes with success, sometimes failures. And it takes 10 years to build a web of people who understand the accounting, the legal, the liquidity providers, the hedging, and everybody that has to be educated. New markets are sold, Don. They're not bought. And I thought in telling the story that people would understand how complex it was and what lessons they could learn from from the failures that I've had and some of the successes that I've had.
Just like the old overnight wonder, the success in show business, where everybody thinks somebody just burst onto the scene only to learn the real story that they were struggling for 10 or 15 or 20 years. And there really is no such thing as an overnight success story. And people will be fascinated to see what the process is, and sometimes how arduous a path it is to get to the point where you finally did, for example, with the climate exchange.
Yes, Don, that's exactly the point. It isn't easy. There's no such thing as a magic bullet. Success is just a string of small fights, one after the other, and that's how the war is won. There isn't a magic bullet.
Give us some of the insights into the process. I'm sure the listeners don't get a chance very often to learn about these steps along the way, how exchanges come to be. A little bit later on, we'll even delve into the volatility exchange, but I don't want to stray from the path of the essence of the book. And of course, we want all the listeners to go out and buy the book. We're going to tell you about a link that we've just set up on the Volex website a little bit later on, where you can instantly get information about the book. But without revealing everything, because it's a big book, I saw it, but take us through some of the early stages, what your thinking was, some of those paths that didn't lead in the right direction, and eventually how things all eventually gel and come together.
Well, let me kind of tell the story of financial futures, and maybe that's an insight that might be of interest to your listeners. I was teaching at Berkeley in the 1960s, and there were a couple of credit crunches in 66 and 69. I had been trading equities at that time and had been doing reasonably well at it. I thought I was smart, Don, but I just happened to be in a bull market, and everything I made I eventually gave back.
Easy game for a while.
Yeah. So somebody said, why don't you start trading commodities? I did. And then as a result of that, I had some technical expertise, and they wanted to start an exchange in San Francisco, but they had no professional traders. So they asked me to develop an all-electronic market, which I did develop, and the blueprint of which is in the book. It ultimately turned out to be the basis for a lot of electronic methods, but we went nowhere with it. The founders of the exchange didn't want to spend, and believe it or not, the $47,000 that would be required to set up an all-electronic market. And so I had been sitting there, spurred by my interest in commodities, and talking to a colleague who pointed out, the credit crunches. And since I was trading, I thought, well, interest rates, maybe we could find some way to homogenize them and trade them. The electronic trading went nowhere, so I put that aside. Spent all my time working on trying to develop a homogeneous mortgage instrument. Time passed. I started teaching a course at Berkeley and futures, which was the first time they were taught in a business school because they were the province of agricultural schools. And I had invited the head of the then Commodity Exchange Authority, the head of Bank of America's hedging, and distinguished guests. And one of the guests was the executive vice president of the Chicago Board of Trade, and one thing led to another. And the Chicago Board of Trade was professionalizing its management, and I was invited to become the chief economist of the exchange. I was, just a young kid in my late 20s, and I didn't want to leave the academic world. So I told him I'd take it, but only if I could do it on a sabbatical. And I promised to build a department and leave it well staffed. Told him I had two ideas that I wanted to pursue. One was on financial futures, and the other was on catastrophe derivatives. And they said I could do that as long as I worked on helping redesign the existing grain contracts, etc. So I went to Chicago, went to New York, went to a lot of big banks, and they told me I was crazy, that interest rates didn't fluctuate, and there was no need for a hedging mechanism.
That was a very wise piece of advice, wasn't it?
Yeah, it was kind of strange. You can imagine the credibility of being a young professor at Berkeley on leave with the Midwestern Exchange talking about this. They thought I maybe should go back to the campus, or I had been influenced by drugs in my thought process.
That's a good thing that you had the attitude, what the hell do these guys know?
Well, anyway, in 1973, the first Arab oil embargo occurred, and interest rates started really bouncing around. So it started to get some credibility. We tried to figure out a way to do it because there was no CFTC at the time. And I worked with Phil Johnson, who ultimately became the chairman of the CFTC, and we managed to basically write the language which enabled financial futures to be born. And theoretically, what we said is that you could trade anything tangible or intangible for future delivery. And as a result of that new definition of commodity, we were able to ultimately launch the first of the interest rate futures, which was a mortgage-backed security called Ginnie Mae's. So the message here was it required legislation, it required understanding. Once the legislation was passed, it required interaction with the new regulator. The Ginnie Mae was the first contract submitted to that new agency in '75. The forms that were required asked questions like, because they were thinking about grain markets, was there enough storage space in Chicago for interest rate futures? A very peculiar question, but it was part of the grain markets, and the CFT was very helpful, helped forge it, and the regulatory model turned out to be very important for the industry. So then began the idea of setting up market makers, which we sold Ginnie Mae permits. It required endless amounts of seminars with mortgage bankers, savings and loans. It required working with the regulators in both the banking community. At that point, there were no financial institutions that were members of the CBT. So it required all kinds of sales on that part of it, and it relied on the need to hedge and the volatility that was unleashed in the late 70s drove the development. We introduced the bond contract, and what's funny, Don, is that at the time we started work on that, the total outstanding issuance of 30-year governments was $17 billion. 17 billion.
Wow.
You know, we auction that in one time these days.
Yep.
And so those worked, but it required an incredible amount of time. It took about 6-7 years of research. It took another 5 years of active marketing before we saw maturity develop. And I think the book talks a little bit about new markets. 0 to 2 years is kind of infancy. 2 to 5 is like teenagers. And 5 to 10, it begins to mature.
It's incredible how we take things for granted nowadays, of course, but there you were as the founder, basically, of a concept that a futures contract does not have to deliver some physical and have them dump a ton of potatoes on your front lawn, but you could deliver a concept, a number, an idea. And even your comment about, where are we going to store these interest rates is just so funny to us today. But obviously, at the time, people were actually serious about things like that.
Yeah, well, the old forms that the CEO used had questions like that, and what I'm really trying to say is these were smart, capable regulators who were willing to be educated, and if it wasn't for that, we would have never had the market. But one has to bear in mind, and we talk about it later, when you go to India and China, and many of the countries that are starting to think of futures and starting to think of financial futures and environmental futures, that it's a very long process, and you have to start with the assumption that they know nothing, and that's a good basis, because the bad part of it is there is no knowledge. The great part about it is there's no vested interests and there are no biases, and if they're open-minded, then you can establish new markets.
And you get to play a major role in formulating those kinds of opinions and get to educate so that you're really in on the ground floor, which of course is the exciting part of the process. So then, of course, let's segue into slightly more modern day and talk about more recent successes that everyone knows about, the climate exchange, but the evolution of that idea and how that came to be such a tremendous success. And then you mentioned China and India and Montreal and Australia and worldwide implications of what you were doing with the environment. I'm sure that's a fascinating story that our listeners would like to have a little insight into as well.
Well, the same thing occurred there, Don. It follows a pattern of 7 stages of development, and I don't want to get too technical here, but the same thing occurred in the 80s. Professor Coase had really laid down the theory of trading property rights to emit. And you had a fixed amount given, and everybody was given an allocation. And if you were particularly good at cutting your emissions, you could sell those excess rights in the market. And if I required a longer time to build a technology to lower my emissions, I could buy yours and be in compliance. And it's not at all complicated. A 5th grade class in Glen Falls, New York, participated in SO2 auctions, and they learned about cap and trade from the teacher giving out rights to chew gum. And the students were allowed to sell and buy them if they didn't want to chew in class. And a market developed for chewing gum rights.
Well, that's funny.
And so, they brought it down to basic levels. Well, in 1989, I was approached and said, acid rain is devastating the United States. People are making movies about it, etc. Did I think that it was possible to trade? Coase's work had laid the groundwork. An economist by the name of J.P. Dales had done some further work, and Congress was discussing ways to deal with acid rain, and I was asked would I help advocate a market-based solution to acid rain, and I did, and we did the first registered trade in the CFTC, and it wasn't really a trade, Don. We essentially went to a utility in Kentucky and bought all of their permits that would be resulting from them building a technology to reduce their emissions. And we paid them for 30 years of reductions up front. So it was really a financing deal. And we sold that to another utility that didn't have enough acreage, because you need acreage to put in the technology. And so the first trade of SO2 rights to emit was actually a financing for a technology that would reduce emissions. As a result of that, I got contacted by the UN, asked if I would come down to Rio and present a paper on if it was possible to extend the acid rain model to carbon dioxide. Acid rain turned out to be a great success. It avoids 40,000 deaths a year. It throws off $120 billion in reduced medical expenses, all at a cost of $3 billion. So I gave the paper and then spent the next 10 years pushing the idea, and ultimately got a grant from the Joyce Foundation, and then started a voluntary market, again trying to convince corporations to take on limits to what they would emit. And ultimately, we got companies like IBM, DuPont, Intel, Honeywell, Ford, Safeway, all to join and produced a voluntary market that was 1/3 of the European market, which was mandatory. So we demonstrated that you could do it on a voluntary basis and proved the concept. Unfortunately, because of a variety of problems which we describe in the book, both on both political parties, the kind of seizure that we're seeing today in Congress stopped the U.S. from taking a role. I predict, and I think we go into this in the book, that while we're going more to command and control in the United States with low growth rates, etc., China, India, and Brazil are going towards markets. So the high growth BRIC countries are going to markets, and we're going away from markets. And that's another reason that I wrote the book, to alert the world that we are in danger of being followers to Brazil, China, and India in how we deal with problems with air quality.
Fascinating, Richard.
Mm-hmm.
I think.
Yeah, no, I mean that is absolutely fascinating. It's incredible the way, politics can get in the way of free markets. I wanted to kind of circle back on just the interest rate discussion. Did you ever imagine that a Ginnie Mae contract would turn into bills, notes, bonds, Eurodollars, you name it, the scope of the market that would be created out of that initial trade, both on the exchanges and traded over the counter? I mean, what you kind of started eventually has turned into the biggest market in the world. What are your...
it wasn't a hard leap. Did I think it was going to happen, and did I hope it was happen? The answer is yes. As a matter of fact, when we launched it, we said that we would hope that we would eventually span the yield curve. Mm-hmm. But that's one thing, by making it theoretical, and to wake up one day and see what started in Chicago is now in 78 exchanges around the world. No, honestly, like anything, I pinch myself about the dream. Now, you dream, but the reality of it is overwhelming, and I would be less than candid if I said I saw this becoming. It was hard to believe. In 1970, when I started in this business, there were 13.7 million futures contracts traded. Mm-hmm. 40 years later, it was over 21 billion for a compound annual growth rate of over 18%. And if you would have said in 1970, do you think that the largest growth industry in the world, aside from technology, is going to be derivatives, futures trading, and options trading? They would have locked you up. Airlines grew at only 5% a year. Then if in 1970 we all sat around and said, do you think airlines are going to be more important 40 years from now, or financial futures and options?
I know, incredible.
Well, not only that, if you take a look at the market capitalization of the CME, ICE, and the CBOE, it's about $31 billion. The top 5 airlines in America, market cap is $24 billion.
It's incredible. What do you think? I'm just fascinated about this NASDAQ futures contract that Don and Bob and Charlie are working on. What are your thoughts on the ability to trade realized volatility? It's something that doesn't exist.
I think that we have ways to trade asset classes that we haven't before. We're beginning to learn. There's the commodities, there's energy as asset classes, there's fixed income, there's stocks, volatility, credit, etc. Some of the new classes of assets that people will want to own. And I think realized volatility complements that need and serves that need. So I think that I'm very optimistic that we will see products such as Volex grow, capture a niche as it fills a need in the market. So I'm real bullish on Volex, and it's a privilege to work with guys like Don and Charlie and Bob, and I think they're inventive. They're looking at a new product class. I'm always fascinated by invention, and it's a privilege for me to be on the board.
Well, Richard, that's a wonderful endorsement, of course. We're honored to have you on the board, and more importantly, we're honored by the confidence that you have in the concept. If we have even a fraction of the success of some of the enterprises that you've been involved with, we'll be very fortunate indeed. And we could go on, I'm sure, for a long time. We're going to move the program along, but we can't.
Thank you very much, Don. It's really a pleasure. And, for those students of capital markets, it's called Good Derivatives. And Don, thank you for putting the link up. And
I'm ordering my copy right now. My copy right now.
Thanks, and have a good afternoon.
Richard, thank you once again. A pleasure to have you, and we'll talk about that link in just a moment. And that's going to do it for our Volatility Viewpoint segment. And now we'll move on to our crystal ball.
And now we take a look at the crystal ball.
And welcome to the Crystal Ball. This is the segment of the program where Mark and I peer out into the future, whether it be the coming week or perhaps the coming months ahead, and try to give you our best views as to where volatility might be going in the short term. And I'm going to kick it off with the NASDAQ volatility and mention that we have been getting those upticks over the past couple of weeks. Mark always chides me anytime I actually mention the word volatility is going higher, and I've been brave enough to step up and call that the last couple of weeks, and I don't know if I'm on a roll or whether this is the end of the line, but I think that from our previous discussion in the introductory vol review, that both of us seem to think that there may be more to come. And whether we look at our friends at the Volatility Institute and the work of Professor Robert Engel with his forward-looking forecasts of realized volatility, whatever the time frame, 1 month, 3 months, a year, they are all considerably higher than the current NASDAQ readings. And I'm going to go out on the limb once more. We'll see if 3 weeks, the third time, is a charm, and say that if you put a gun to my head, I think that we see realized volatility on the NASDAQ higher 1 week from today than we're seeing right now. How about your viewpoint on S&P and VIX and the coming weekend?
Yeah, I mean, I'm interested. I'm not as bullish on VIX as I am on S&P vol. It's going to be interesting if Sarkozy wins over the weekend, which the market is not expecting. We are going to get a massive snapback. And the way that we're seeing kind of oil sell-off and we're seeing gasoline sell-off, and I think we could see the S&Ps continue to move. You know, we're going to see kind of the normal weekend VIX. I think even given kind of off 20 points, the VIX is going to have a lot of trouble breaking kind of 20-21% here. I think we're going to continue to see movements of 1 to 1.25%, maybe up to 1.5%. But if the S&Ps move 1%, Don, I know you know this, but if the S&Ps move 1% a day, what is that on an annualized realized volatility?
Only about 16%, and so
exactly.
Yep.
So, and I don't think we're going to. I don't see us moving consistently above 1%. I just don't see a market where any sell-off. I think, as you said at the top of the show, orderly. I think we'll continue to see these 1% moves. I'm not sure how much more upside we have in VIX beyond 20%. So
what you're saying, Mark, is you think that the marketplace will realize that and that they won't allow that disconnect between the spread of implied volatility and realized to get too far away as it did a while ago, that even
right.
should the market sell off in orderly fashion, that there'll come a point where maybe VIX simply won't go up anymore and the spread will not continue to widen.
Yeah, I mean, I'm putting a top on the VIX at, if the VIX... Here's what I'll say, Don. If we get the VIX breaking 21, we may go to 25, but I don't see that happening. And if we go to 25, we go to 30. But
right. Katie bar the door, huh?
Exactly. I think that 21 level to me is where is kind of the where things go from orderly and bad to bad and bad, if that makes sense.
Yes, absolutely. Well, thank you for that, Mark. That's going to do it for our Crystal Ball segment, and that's also going to do it for this edition of Volatility Views. We thank everyone for listening, and we look forward to our regular host, Mark Longo, joining us again next week. But
well, at least one of us looks forward to it.
Yeah. But before we do go, Mark, tell us a little bit about any upcoming webinars, seminars, any activity over there in the options pit, and what our listeners can look forward to and what they can subscribe to in the days ahead.
Yeah, we've got our continuing series of free webinars coming up Wednesday, May 16th on trading weekly options. My book is getting ready to come out June 3rd. It's The Option Trader's Hedge Fund. When you buy Richard's book, buy mine with it. I think that you'll get the 2-for-1 discount special.
That's what we got to do, a package deal there. We got to put these together.
Mm-hmm. Exactly.
I wish you lots of good luck with the book. I took a look around Amazon and again took a look at some of the introductory material, and it looks like you've put together a real winner there, and I look forward to reading the entire book. And really, it's terrific. This is traditionally the time where Mark asks me what's new over at Volex and what's going on. I'll simply tell everyone that you just heard this fascinating interview with Richard Sandor. He's written a marvelous new book called Good Derivatives, a story of financial and environmental innovation. And our great webmaster, Norm Wattenberger, has put up a link on the Volex website. So on the very home page, right in the front at the top at Volex announcements, you'll see a picture a couple of lines down of Richard, and we have a link to his book that'll take you right over to Amazon with the description. You can actually see a short clip with a 2-minute interview of Richard. So go on to the Volex website, take a look at the link, and take a look at Richard's new book. I'm sure you'll have a great time. That's going to do it for this week's program, Volatility Views. We thank you all for listening, and we hope you'll join us next week here on the Options Insider Radio Network and Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volex.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volex_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.